Good morning, everyone. Thank you for joining us. David Moore, Equity Advantage, and we will get the show on the road momentarily. We've got the wonderful gray skies behind me now in Oregon. I'm fearing that our wonderful summer. I know we've got a heat wave coming up this weekend, but it feels like it's waning a little bit. So hopefully it doesn't go away too quickly for us. But definitely changes in the seasons of the real estate market. So we're going to talk about doing deals in turbulent times. Today's topic, 1031s in turbulent times. We'll talk about some things that we're seeing, like seller finance, obviously vesting issues, reduced loan to value, some other things that are coming up with respect to transactions that are going on. And I guess what I'd like to say, more than ever it's more important than ever before, really planning what you're doing. So as far as understanding 1031 and it's tax deferral, but really we want to know, where you are today and where you want to be in 2, 5, and 10 years, and how we're going to help you get there. So Wall Street argues they don't have 1031, but Wall Street's got trillions of dollars, tens of trillions of dollars in IRAs and 401k plan money. And I would say that 1031 is just the real estate world's IRA. So we'll talk about obviously basis gain, 1031, why you're going to be looking at that stuff. We'll talk briefly about some of the retirement account stuff, actually blending personal funds and IRA 401k funds into common transactions, different ways to do that. Whether you're taking money out of your pocket to go buy something or you're actually doing an exchange into something, and how you can accomplish those objectives using both tax money and qualified funds, meaning IRA 401k funds. So we like to say you've worked hard for your money, we work hard to keep it yours. There's absolutely no such thing as a dumb question, all right? And I always sort of joke that I'm always happy to learn, tired of being taught. So it's better that we talk about things, ask those questions earlier rather than later. Understand that 1031's biggest problem is always going to be time, and I see a lot of seasoned brokers on this call, so I don't have to tell you guys that, the guys and gals that. But it's one of those things where the market is definitely changing. Things like seller finance that we hadn't seen for probably at least a decade are all of a sudden back and big, and obviously we need to sort of clarify your options when entertaining an offer on a seller carry, and actually to have people understand what the tax repercussions are for somebody doing a seller carry. And this is one of those things where if you type in seller finance on YouTube, and you can thank a variety of different organizations for this interest, but it's really, as my father used to say, anytime you read something about something you know something about, you realize how wrong it is. So I want to dispel the fallacy that you can't do an exchange with a seller carry, but it is more complicated. We'll talk about 5 different ways to do it, but it's really important to understand if you're representing, if you're a broker in a deal, who you're representing. And if you're representing a seller and entertaining a nothing down or very low down seller carry, understanding what the tax repercussions are going to be for your client, because it's not for the meek. And what I mean by that is people don't understand. They just think they're going to pay tax on the principal payments as they come in, and that's not at all the case. So there's definitely a situation where people need to understand and explore these concepts sooner rather than later. And that's what today's presentation is about. So we are going to get started now. You guys are here on time. I don't want to penalize you for that. So David Moore, Equity Advantage. My brother and I started Equity Advantage in 1991. And we actually had an investment partner at that point in time, and a mentor actually that was a partner at the firm's inception. And it's been a fun ride through the years. And in the mid 2000s, we actually put IRA Advantage together to handle self-directed retirement account investments too. So in either place, we do not sell investments. We don't give investment advice. We're here to help you get out of what you don't want into what you do want, whether it's personal money via 1031 or qualified money via IRAs and 401k plans. And as I said earlier, it's even possible to combine those two sources of funds. So we're going to go through my basics, my cornerstones of the exchange process. We're then going to talk about what's happening with the market options that are there, the tax liability, what people are doing, and then provide you some examples at the end of the hour. And I have a tendency to speak quickly and possibly go over, and I apologize for that. It's sort of hard for me to trim material out of things. And you might, for example, the cornerstones might be something you've seen before, but it's critical that we establish a base knowledge of information to work from. And I want to also mention that this presentation will be up online on our YouTube channel after it's up there. And you also, if you need credit hours, if you're in Oregon, for example, we can offer you credit hours, CE for real estate. Please reach out to Seymour at 1031exchange.com. If you're curious about content on YouTube, please take a look at YouTube, our YouTube channel. Please like and subscribe that stuff. It really helps us out. But if you're looking for content that you don't see, please reach out, let us know, because we're always looking to offer information, whether it's 1031 related or just investment related. It's going to be important to our broker clientele and our investors, and even the tax and legal clientele too. So on our YouTube channel, you're going to see everything from videos on cost segregation to qualified opportunity zones to even selling life insurance contracts. And these things are all there because people are looking for sources of funds to do different deals and in different ways to get them done. And sometimes, upon a disposition, if you're curious, you're not really sold on an exchange, take a look at the end games presentation there. That's going to give you a variety of options that are there in addition to 1031. At the end of the day, if you're just saying, hey, I'm tired, I don't really want to deal with real estate anymore, because those of you that have real estate out there understand it's not the easiest thing in the world. It's a wonderful investment opportunity, and one of my unfortunately now deceased mentors, a guy Bob Nelson, used to say that real estate's not a get-rich-quick scheme. It's a get-rich slowly but surely scheme with one golden rule: don't get yourself put in a situation where you've got to sell during a recession. So I'm not saying we're in a recession at this point in time. I'm just saying, be careful what you're doing, understand what your options are, and really work with what you know. And as I said, every day I sort of wake up and it's like, well, gee, I didn't think that was possible, and here we are. So here we go, 1031s in turbulent times. Why do we even think about an exchange? Why do we worry about that? And if we're looking at something with retirement accounts, for example, what is in the account? You're looking at a tax deferred gain situation with IRAs and 401k plans too. The real difference between IRAs and 401ks and 1031 with money out of your pocket is that the 1031 sort of works, as I said, like an IRA for real estate. The beauty of it, though, is that at the end of the day, if you choose not to do an exchange, if you've held the property or asset for a year or more and held it for investment, you're looking at long-term capital gains tax consequence. Where with retirement accounts, any funds that come out are going to be taxed at normal income tax rates. So, and sort of the silver bullet of 1031 really is the whole concept of swapping till you drop, right? So what that means is that you can exchange throughout your life, kicking that tax obligation down the road. And at least the way the law works today, and today meaning that September of 2023, because future viewers, a decade from now might be looking at a different tax situation. But the idea is we work with the laws that exist at the time we're doing this stuff. And the way the law works today with stepped up basis is when you pass away, your heirs will receive the property or properties at current market value, that stepped up basis. They could turn around the next day and sell with no tax obligation in most cases. So it's really an attractive thing. And a lot of times, I'll just mention up front here that we're doing lots and lots of work in the institutional real estate world. And what I mean by that is, is Delaware Statutory Trusts, DSTs, or institutional tenancy and common properties. And one of the options in the DST space I really like is something called a 721 UPREIT right now. So it's the ultimate installment sale. It gives you the ability to pay the tax as you choose to pay the tax, meaning that what you're doing with the Delaware Statutory Trust is you're deferring your gain into this, passive investment, mailbox money, which is typically going to be a multi-asset offering, non-recourse debt on it. And the biggest objection people have to those things typically is that you're married to it for 5 to 7 years, and it's stabilized assets, and they're not going to just turn the asset until the sponsor feels there's a reason to do that, where they can maximize the yield. So you're sort of stuck with the thing. Well, the 721 UPREIT allows you to exchange into that Delaware Statutory Trust, which is held as such for a year or two, let's say, and then via 721 UPREIT, your interest in the DST gets converted to shares of a real estate investment trust, which then, as soon as that's happened, the negative of that conversion is that you're now dead-ended. There's no way out of that transaction without paying tax, but the upside is that you just pay taxes, you sell the shares of that REIT. So it's really the ultimate installment sale, because typically installment sales, you're going to have some other tax hiccups, which we'll talk about in a few minutes. But I really like that option for people. Understand that you are receiving, at the end of the day, shares of a REIT, and the shares of the REIT can go up and down in value just like any other investment. But it's really a wonderful thing, because you're not going to have the tax on debt relief and depreciation recapture in that initial transaction. So it's really an attractive thing for people sort of, looking at their own mortality, and maybe they're terminal, and it allows you to get into these things and then offer your heirs the liquidity that they desire in the future. So just planning stuff, and as I said, really look at where you are today and where you want to be in 2, 5, or 10 years, and we'll help you get there. But gain is why we look at 1031s, period, and gain has nothing to do with profit on a property. Gain can actually be triggered even though you've got a loss, and you're saying, well, David, how can that be? Well, what is gain? Number one, gain is just simply the adjusted sales price minus your basis in the property. Your basis in the property is what you paid for it plus the capital improvements done to it during the time you owned it minus depreciation. Now, the purchase price varies depending on how you got the property. If you exchange into it, you got basis carry forward. If you add a home that you'd sold and bought a new home pre-97, that was a 1034 transaction as basis carry forward. 1033 involuntary conversions basis carry forward. If I gave you a property, your basis is mine. If I pass away, you get stepped up. So that quote unquote purchase price really varies dramatically depending on how you receive the property. Pull money out of your pocket, obviously that's the purchase price is the quote unquote purchase price for basis calculations. Capital improvements. So during the time you own the property, everybody that owns property is putting money into that property. So the question is, what was done? Is it a capital improvement, or is it maintenance and repairs, let's say? So expensed items versus capitalized items. Capitalized items increase your basis, expense items do not. And then depreciation comes into it. And I've got to really stress it. We're just one member of a successful investment team, right? And we're going to have on that team of professionals, good, competent tax and legal people. I mean, people that you're paying to take a position on your behalf, not people that you're paying to learn on your behalf. So it's really important that you're working with people that understand that stuff. But I think great tax people are probably some of the most important people in your life today, because it's just such a crazy world, and really there's things out there that if you're just paying somebody to do a tax return for you, or doing your own tax return, you may or may not be doing, and may not be getting the biggest benefit of. And I'll drop that down to the most basic sense. I mean, if earlier when I was talking about videos on our YouTube channel, I talked about cost segregation. The most basic form of cost segregation is, let's say you buy a rental house and somebody's making an allocation to the improvements. Well, who does that? I mean, when was the last time you looked at a property tax statement that was remotely accurate, right? And if you jack up the value of the improvements versus minimizing the value of the improvements, what happens to your return on investment? If you jack up the improvements, you're increasing the depreciation you're taking, and therefore it's increasing your ROI. You drop it the other way, it's the other direction, the other thing's happening. Cost seg is basically just taking what might be a 2 allocation dirt and improvement situation and busting it into a couple hundred components. And they're typically engineering based, and you got to talk to somebody in that space, like my buddy Jonathan Frizzell, that specializes in that type of thing, and they go in, do the studies, and figure it all out. And really, what you're doing is accelerating depreciation. So you're not getting more over the life of the investment, you're just getting a lot more over the time that you want to get it. And so that any institutional offering, you got to understand DSTs, TICs, they're all doing cost seg studies. So understand that's happening. And at some point, you're going to deal with, obviously either paying tax on depreciation recapture, or you're just working things going forward. But it's really important to understand what's going on. And once again, have good professionals in your life, good tax people, good finance people. Finance people are going to take care of you. Good title escrow people. Working with people in the 1031 exchange, if you tell them an exchange, they know what's involved. I mean, a good professional escrow officer is going to really be a huge asset to you. So, use good people to understand what's going on. And you're not going to have some sale close without being structured as an exchange because somebody didn't know what was involved with those things. So it's really important to work with that. Good property managers, understanding, working with a property manager that understands that they're working for you, not the tenants, right? And that's a really difficult thing in today's world, is getting good people there. And a lot of people, the mom and pops in today's world, it's really getting to the point where these high rent control cities, states, where it's very difficult for people to stay on top of the laws. The tenants all have all these advocates, shoving things their way, but you need to make sure you understand you're following the laws the way they are, and a great management company is going to be there. So I made a comment about gain has nothing to do with profit. Okay, gain can be triggered by depreciation recapture. You can actually have losses of losses on a property, or a loss of an entire property. So we haven't fortunately seen it in a few years, but probably for a decade after the last crash, we were doing mop-up work in the institutional world where we had people losing assets to foreclosure and being hit with phantom gain. You're going, David, what's phantom gain? Phantom gain is gain that's triggered through let's say, short sale or foreclosure, where the debt is in excess of the basis. So what happens in a phantom gain situation, or with a short sale or foreclosure, is if the debt on the asset exceeds the basis, that difference between those numbers is gain, and that's called phantom gain to you. So you can have a situation on a home where if you lost a short sale or foreclosure, where you're going to have some tax relief. On income properties, you don't. So you can lose the property and actually pay for the tax of privilege, tax on the privilege of doing that. So a lot of times you say, well, gee, David, you're not getting any money through the exchange, and obviously any exchange requires that we isolate the taxpayer from actual or constructive receipt of funds. In a foreclosure, there's no money coming out. So what do we do with that? Well, the assignment of ownership has to happen pre-foreclosure. So that the asset's going to be transferred to us before it's foreclosed. And you're saying, well, gee, it might be a deed restriction, blah, blah, something else. Maybe it was a TIC, and the TIC agreement prohibits this, blah, blah, blah. Well, you know what? You're going to lose the thing anyway. So, and what are they going to do? Call the loan on you, or say you can't do that? So the idea is we're going to isolate you from actual or constructive receipt of the debt relief. And the reason we do that is, you think about what your gain is on a property. Your gain, and I've got the next slide, the tax hit on this thing. So understand that what is the tax hit for most people, and you're looking at tax rates at different levels depending on whether the gain is appreciation or depreciation recapture. So typically our clients are looking at 20% tax on appreciation, 25% on depreciation recapture, and that's fed. Then the states are going to hit you on top of that. States could vary anything from zero, like in Washington or Texas or Florida, we've got up to almost 12% in Oregon now. California's similar there. Plus, on top of those numbers, you could be looking at the 3.8% healthcare tax too. And this is assuming that it's long-term capital gain. It could be a situation where you bought it, now you're selling it inside a year, and now you've got normal income tax consequence instead. and that's going to be problematic for you. So typically you're losing, maybe 35, 40% of something to tax if you're in a state that has state taxes. And the answer to the question is pretty easy for people looking at one of these phantom gain transactions, because they're just going to pay 35 cents on the dollar for that privilege of losing the thing, or maybe they are just going to come out of pocket roughly the same amount, or maybe even less. If it's a 70% loan to value, you're looking at 30% down, and you can go buy something. And understanding that in some of this mop-up that I mentioned from the last crash, it was institutional losses, non-recourse debt, so it didn't ding our clients' credit, and they were able to go get loans going forward. There's also situations where in the Delaware statutory trust world, if you're looking at a situation where you lost things, if you're still an accredited investor, you can go out and buy into a mix of Delaware statutory trust offerings, and that's all non-recourse debt. And you might have a situation where you're blending some of their traditional investments with what they might call, for example, Inland Private Capital's got a zero coupon offering, which is a higher leverage investment that maybe doesn't give you that monthly quote unquote mailbox money, but it's isolating you from the tax liability, and then during the time, that 5-7 year hold, you're going to be increasing your equity and moving forward at that time. So you're getting into something that's accomplishing your transaction, getting you totally tax deferred. You might not be getting monthly cash flow, but at least you didn't have to lose, just walk away from that money via the gain. So it really, back to my comment on questions, look at the resources you got, ask the questions that are out there, and really work to, if you're the broker, work to give your people options on where they're going to go. If you're the investor, really work to understand what your options are. And like I said, on our end game presentations, it's 1031 is a component of that. That's an end game, but you might go into a QO0Z, qualified opportunity zone, or an opportunity zone, and that might be just a fallback too. And by the way, if we're looking at selling a home, you've got gain. If you've got gains beyond the 250 or 500 that Section 121 offers, a QOZ could be a nice solution to mitigate some of the tax exposure you have beyond the 250 or 500 that 121 offers. So, once again, these are all concepts that are out there, and a lot of ways it's sort of well-kept information, but working with people that understand what's there and asking the questions, you're going to open up doors. And really what we're all about is market liquidity, right? And what's interesting to me is that there's some proposals out there you need to just be aware of, and you look at different market segments right now. And for my hotel motel brokers and investors, from what I'm seeing and hearing, insurance is starting to be a problem, especially with, let's say, hotel motels with corridors on the outside. It's really tough to get them insured these days. Well, if you can't get insured, how do you sell it? And now we're looking at a situation where, for example, in California, they're saying, well, 40-year-old apartment building, you can't get financing for, and that's due to slide to 30 years. Well, or not financing, I'm sorry, insurance on these things. So, if you can't insure it, how are you going to buy it? You're not going to, and how are you going to sell it? So it's really, and furthermore, if we want affordable housing, those BC buildings, those older buildings are the things that are affordable. And if you don't allow liquidity in the market, think about any time a property sells, what does the buyer do? The buyer injects money. The buyer makes the thing better typically. So, you stop the liquidity and you've got an erosion of the quality of the real estate. And it's really not a healthy thing for anyone. And that insurance tsunami is sort of over the horizon at this point, but it's just I'm leery of it coming forward, and I'm seeing it sort of trickle into different market segments. So just be aware of that. Keep an eye out on what's going on, eye and ear out for insurance and how that's impacting transactions in the commercial investment space going forward. But once again, gain is simply the adjusted sales price minus the basis. The adjustments on the sales price would be broker's commissions, title escrow fees, tax and legal fees, our fees, current property tax prorations, whatever that number is. Maybe take 6-7% off the top, and that's going to be the adjusted sales price. And from that number, you're going to subtract the basis, and that's going to give you the gain. So, and by the way, having tax exposure is one thing. Actually having taxes owed is quite another thing. So be aware of that too. So I mentioned different states, different tax consequences. Take a look at this map. The gray states obviously are popular for a variety of reasons. One, that they have zero state tax. Two, they're typically going to be a more conservative state, more owner rights. So landlords are happier in those places. The strike state, for example, Washington, up that top left, it's banded because certain assets in the state have capital gains tax, thanks to Washington Association of Realtors, NAR. We don't have the capital gains tax in that state applying to real estate right at this point in time, and hopefully it stays that way. But you can see a variety of different rates coast to coast. And keep in mind also, it used to be a great idea for you to exchange out of maybe a high tax state into a low to no tax state and then hold the property for a year or two and then sell it. Oregon put a clawback provision in the late 90s. California saw them do that, said, hey, that's a great idea. We're going to do it too. So some of these states, you got to be aware that yes, you can exchange out of the state, maintaining total tax deferral, because every state in the union today follows 1031, but the issue is whether or not that state reserves the right to claw back gain that was deferred out in the future. So what I'm talking about is, let's say you exchange out of California into Texas, you hold the property for a year or two, then you sell the property, triggering gain, and you think, well, gee, I just saved up to 13.3% state tax. Not true, because California is going to have the right to claw back the gain that was deferred out of the state. Now, the additional gain, realized in Texas won't have a consequence in California, but the gain that was deferred out of the state would be clawed back on a future disposition if it's taxable. Now, if you continue to do exchanges, you're fine, but just really before you close things, understand what the tax liability is going to be, what future options you've got there, and understand that a lot of these things that used to be great ideas no longer are. Another example of something that used to work that doesn't any longer is just exchanging out of a pure investment property into a new quote unquote investment property that you then convert to your primary residence. If you were to do that and you were to, let's say, exchange into that quote unquote investment house in South Beach, Miami, let's say, and you hold it for a year or so, then you move into it, there's no tax on the conversion of that thing. If you were to sell it within 5 years of acquisition, trying to use 121, so if you sold it as a primary residence, it's going to be a fully taxable sale. And then even after a 5-year hold, you're going to be subject to something called the Housing Assistance Tax Act. So what used to work, and there were a couple of years where it did work, it doesn't work. It hasn't worked for a long time, but that information, people come up with these great ideas, and unless they've got exposure to it, they don't understand that the government does plug those holes. It just takes them a while to figure it out. So these are things that people say all the time that are just wrong. And remember, I made the comment earlier about my dad's comments on things you're reading about or watching. And so one, like kind does not mean house for house, land for land. It never has. And when I got into this business, I had a lot more hair on my head, and I was a lot younger guy, and people used to say, well, I remember when it used to mean land or house for house, land for land. It never has. It's just one of those things. It's just bad information that's been repeated over and over again. And just because it's been out there for a long time and repeated over and over again doesn't mean it's true. It's not true, nor has it ever been true. So when we're looking at like kind in 1031, it refers to the nature of the investment rather than the form. So you can exchange out of a rental house into dirt, into office buildings, apartment buildings, place to retire, into all those things are going to be fine. So you're giving up property you've held for investment, you're acquiring property with the quote unquote intent to hold for investment. 2, Section 1031 does not require 2-year hold. And people say, well, gee, David, the code does say 2 years. Well, yeah, it does. If you're my brother or sister, mom or dad, well, that's a related party transaction. And in that situation, or let's say a legal entity you own a controlling interest in, those things are all related party transactions. And in that situation, the code says 2 years. Now, anybody that's a tax professional will tell you rarely is it a black and white answer in the tax and legal worlds there. So we're looking at hold periods in 1031. even with a related party transaction, if you read the fine print, it says 2 years unless there was no intent to avoid tax. So even in a related party transaction, it's not an absolute 2 years. That's why you want good tax people. But if it's an arm's length transaction, there's no stated required hold. If somebody's pushing me for a hold period, I'm going to tell them a year based on 2 factors. One, it's been proposed a couple of times. 2, that's the break between short and long-term tax rates on assets held for investment. So who am I to argue with the federal government if they're drawing a line on investment at 1 year? So I think really you can hang a hat on that 1 year time. If, like I said, if you're buying a property and then converting it from investment to residence and selling it, there's a 5-year hold there. But beyond that, really, and it's funny because the most viewed video we have on YouTube is the 5-year hold. And we put that up because people kept asking us about this 5-year hold in 1031. And like I said, it's not a 1031 issue. It's a tax issue for a property that was acquired via 1031 and then later sold, attempting to use Section 121, the universal exclusion. So there's restrictions there. The government saw money going away and they tried to stop that, stem the tide on funds going away, first with the 5-year hold and then with the Housing Assistance Tax Act of 2008, which really plugs the hole because it gives you prorations, the 250 or 500, and those prorations are via the amount of gain attributable to qualified versus non-qualified use periods from April of 2009 to date of, so the non-qualified was the time from April of 09 to the date of conversion from investment to residence. That's all non-qualified. The time you lived in it is qualified use. So you can sort of figure out, obviously, the longer you're in that property, the more you're going to shelter via 121. Do the deal understanding that, hey, I'm gonna buy this property. At some point, I'm going to move into it, but I'm going to live there for the foreseeable future. Don't do it thinking, hey, I'm going to get rid of the gain because it doesn't work. 3, there's no limit to the number of properties relinquished or received. All right, I'm going to say it again. There's no restriction on the number of properties relinquished or received. The identification rules imply that there are, but it's totally not the case. You've got 3 different identification rules. The first rule says you can ID up to 3 properties of any value. So that's the one that restricts the number of properties. Now there's a 200% rule and a 95% rule that are outside of that. So if you want to ID more than 3 properties, you can. The total value of the properties ID could not exceed 200% of the relinquished properties value, or, and it's not an and, it's an or, you can exceed 3, you can exceed 200%, but you got to acquire 95% of the aggregate value of all properties identified. So, when we're looking at identification, understand one, that the biggest problem with any exchange is time. You've only got the 45 days from settlement to ID what you want to buy, 180 days to get it done. But what the government wants is an unambiguous description of the property or properties you intend to buy. And then furthermore, you have to receive quote unquote substantially the same thing. So, once again, I'm sort of looking at gray there, right? And you can change your mind anytime up till midnight the 45th day on these things. If you're buying a piece of something, you need to identify the portion you intend to buy. And understand 1031 is not all or nothing. I mean, we'll talk about the napkin test further in a little while, but every dollar you spend over your basis represents tax deferred gain. Now, property does not have to be on the market to be identified either. I mean, does a property have to be listed with somebody to be purchased? Absolutely not. So understand that when we're looking at the 200% rule or 95% rule, there's huge variables with respect to what something is worth. So, keep that in mind too. Number 4, you can carry a note or land sale contract and still do an exchange. People say, well, gee, you can't do that. Now, at the beginning of today's presentation, I mentioned that we're going to be talking about seller finance. First thing I want to say is for you to buy on a seller carry in an exchange, totally fine, great, wonderful. As far as selling and carrying a note trustee or land sale contract, it gets a lot more complicated. And if you ask me, I'd like to see note trustees, not land sale contracts. And what's the difference between the two? Well, one, escrow officers are typically going to be able to draw the note trustee for you, but what happens to note trustee is that title goes to the buyer and the seller gets a note secured by that deed, right? So So as far, which leads me to this, because land sale contract, I sell to you, if I'm selling to you a property and I'm carrying a contract, I have title till you pay me off. Now, which leads me to this. Does title indicate ownership? No. Benefits and burdens of ownership do. So if I sell you a land sale contract, you own the asset, even though I've got the deed until you pay me off. Note trust deed, that note is going to the buyer, and you've got that note that's going to be handled. I like note trust deeds better. One, like I said, you just have escrow draw thing, but two, I've got a number of clients through the years that have had a borrower that's treated them very well. And so they might elect to do an assignment of collateral. So you could be the lender on the property you initially sell. And if they're a great borrower and you choose not to have that note paid off at time of disposition, you can elect to go forward and have a substitution collateral the next asset they buy too. So those are attractive things. It's a lot easier for us as an exchange company to deal with a note trust deed too, because what happens selling and carrying paper with a note trust deed, just as the money comes to us at close, that note's going to come to us at close, and then we have to do something with it. We'll talk about notes and different options to convert the thing, but this is something we really haven't dealt with for a decade. Now, all of a sudden, in the last 2 months, for example, we're dealing with seller finance questions day in, day out. And I will also mention that a seller finance, if you're doing a reverse exchange, doing seller finance on the relinquished property is really not a problem, because in a reverse exchange, and I'm just going to talk about it real quick right now because we're not talking about reverses, but reverse, you cannot legally own the new and old property simultaneously. You can only own one or the other. So what happens with the reverse, if you've got the financial ability to buy something today, replace something yet to be sold, you're going to show up to purchase that property with the money required to buy. We're basically signing a note stating that we borrowed that money from you, and we buy the property. And a warehouse replacement means we're taking ownership of the new property until the old sells. A warehouse relinquish means we're going to buy the property, give it to you, and you simultaneously give us the property to be sold. Now, when the property sells in the future, the proceeds from that sale come in to replace that debt, repay the debt that we have to you for the initial down payment. Now, I just said seller finance in reverse is not the problem that it is in a delayed, because in a delayed, the note represents equity, and somehow we have to use that equity carried forward for total deferral. In a reverse transaction, you've already loaned us money. So for us to simply use that note we received on that sale to repay the debt we've got to you, that's fine. That works great. So we're just really looking at numbers there and making sure they all match up for the napkin test. But seller finance on a relinquished property in reverse, obviously on the buy side, it's great. On the sale side, it works fine too. And if you've got a situation where you're dealing with that stuff, let me know and we'll send you some information on it. All right. 5, you do not have to replace debt in an exchange. Now, this is one that's certainly coming in more and more today, and we'll talk about it a little bit more at the napkin test. But what happens in recessionary times? Typically, you're going to have a reduced loan to value that's available to you. You might be giving up a property that's gone down in value, so you may have a reduction in equity there, and inevitably you might have to be injecting funds into a purchase to make it happen, or maybe you just can't get financed. You got to buy it outright. So all those things are fine. Debt can go away 2 ways, and we'll talk about it again, so I'm going to repeat this in a few minutes, but debt can go away 2 ways in an exchange. One, by going down in value, which triggers tax. You went down in value. The other way debt goes away is by adding cash, which is always fine. So you don't have to pay a property off. If you're saying, well, gee, David, I can't have any debt, or I don't want any debt on the replacement, so I'm going to pay off the relinquished property pre-disposition. You don't have to do that. Just show up at the purchase of the replacement with that money. You're going to be fine. There's no need to pay off that relinquished property or pay down the debt on it, because you're going to have less debt on the replacement. It's unnecessary. And then finally, 1031's not an all or nothing affair. So what I mean by that is, for total deferral, you have to satisfy what we call a napkin test, as you're going across or up in value and equity. But maybe you're giving up a $500,000 property. The perfect replacement property is $400,000, and you have a basis of $300,000 on the property that went away. Well, in that scenario, you're deferring the gain on the difference between the 3 and the 4. So you're deferring tax on roughly $100,000 of gain, might save you $30,000, $35,000, and you're going to have exposure on the difference between the 4 and the 5 net of closing costs. So, buy what you want to buy, just understand what the tax obligation is going to be and be prepared to deal with it. And this is why, once again, your tax people are so critical. You don't want to talk to them April 14th. Really talk to them before a year's end and do some planning, and talk to your financial advisors too, because maybe you've got some gains or losses to offset gains or losses in the real estate world. Tax exposure is one thing. Actual taxes owed is quite another. So really get good tax people, work with them through the year. Don't just have them do a tax return for you, because really they're not able to help you after the fact. Really use them. One, anytime you contemplate a sale, people ask, well, when do you want us to think about the exchange? I'm going to tell you when you buy the property. But at least when you contemplate a sale, first call you're going to make is to your tax people, understand, hey, this is what I think this thing's worth. What's my tax consequence if I sell it? And then at that point, you know whether the exchange is going to make sense. All right. And that's a conversation needs to happen way more often than it does. And the number of calls that I take in a day or a week or a month and talk to people every day about basis and gain, their tax consequence, and a lot of times people don't know what it is. So they'll ask, well, should I do the exchange? Well, I don't know. I have no idea until I understand what your tax liability is going to be. And there's an opportunity cost to a 1031 too. For those of you that have been in exchanges, the biggest headache's time, right? So if you know you have to buy something within 45 days of that date of relinquishment, there's an opportunity cost there. You look at the world today, what do you think's happening? Is values going up, down? Is your ability to buy something going to go up or down? What's happening with the interest rates? Are they going to go up or down? If they go up, what happens? If they go down, what happens? So really, in recessionary times, the old saying, those with gold make the rules. So if you've got patient money just sitting there ready to jump on opportunity, then that's a huge benefit. If you're in a situation where you're wanting to just defer tax on $5,000 today because you don't want to pay the tax, and I'm going to say, maybe you ought to pay the tax and have that money ready to jump on the opportunity, because $5,000 in tax, what's your ability to get a $5,000 better deal if you wait a couple months, right? So really understand what's going on there, and a lot of times people are buying 45 days to figure out what's going, what they want to do. If they get the 45th day and they haven't found anything, that's okay. If you get to the end of the 45th day, don't identify something just in case, because we're going to talk about 1031 G6, and that tells you when you can get money out of a deal. Don't ID something on day 45 just in case, because what happens if you find the perfect property on day 60 and I can't legally give you your money? Now you're upset. I'm upset because you're upset. Your broker, if you're the broker, you can't make that deal. So if on day 45 you haven't found what you want, my advice in today's world is to terminate the exchange on day 46. We can give you the money, and then you can go out and buy what you want to buy, or look at ways to mitigate that tax. And a QOZ, once again, QOZ or OZ, opportunity zone, qualified opportunity zone, is a way to mitigate some of the tax consequence in this stuff. So it's sort of a fallback. If you're in a situation where you're just not wanting to you're not finding what you want, you don't want to have the tax hit, obviously the institutional DST and TIC world is there to accommodate your needs. Understand the difference between the two of those things and what the benefits and pitfalls of each of them are. But there's always product out there that you can acquire at the 11th hour. And with the DST, it's all stabilized assets, non-recourse debt. So if you're living off the cash flow on the properties that are now gone and you need the cash flow to be working right away, typically you can plug your funds into a DST, and within a week you got that money working and giving you some type of return on investment. So just look at those options that are out there, and obviously ask for whatever period of time you feel you need to get that relinquished property closed. Don't let it close any earlier than you need to if you don't know where you're going. On the other hand, you can go ahead and negotiate the purchase or replacement before your relinquished property's closed, and just kick that settlement date down the road to make sure your deal goes away. So conversion of property, right? So we've talked a little bit about this, and the example I gave you was on the acquisition side. So a property acquired via 1031 and then converted into a primary residence. Well, in today's world, It's also very possible that selling your home, you're going to have a big tax hit because that 250 or 500 that Section 121 offers you, that those numbers in 1997 meant something. Today, 250 or 500 in gain on the sale of a primary residence for a lot of people means absolutely nothing. So there's many clients that we have come into us. If you've got a lot of large income properties, if you're broke and working with somebody that's got a lot of income properties, bigger stuff, look at the value of their home and I mean, understand that the sale of their home quite possibly going to trigger tax consequence. Now, you can have a single asset with allocations different directions too. And an easy example to contemplate is the duplex half owner occupied. So the owner occupied portion is going to get 121. The investment component is going to go 1031. Maybe you've got a house on acreage. You've got the house and maybe a couple acres as your primary residence component, then the balance of it is 1031. So you got a single sale, allocations different directions once again. Well, some of you might be working out of your home, especially since COVID. A lot of people went home and never went back in the office. Well, that home office, you might talk to your tax people and say, well, gee, you know what, Susie, you're working out of your house now, so let's treat that portion of your home that you're working out of as a home office, and therefore now we're taking depreciation on it. Well, be careful there if you sell the home, because if you've treated that component as a home office for more than 3 out of the last 5 years, you're now in a situation where when you sell your home, the home office component has got to be 1031, or you're going to have tax exposure on that thing. So, we can convert an investment to residence. We can go residence into investment. We can have components of these properties. For example, the attached dwelling unit. You go to sell the property. What are you selling? You've got the home, which is 121. You've got the ADU, which is 1031. So many situations where you've got mixed situations, and you can convert both directions. It just takes time, and you really want to look at the tax codes that are available and maximize each of them. And like I said, 121 in 1997 meant something. Today it means very little. And the beauty of this situation is we can convert things back and forth. It just takes time to do it. So next question, I just said it takes time to do it. Well, David, what do you mean time? How long is long enough? And I talked earlier about that 1 year, right? And I also stated that it's not black and white. I mentioned the 2 years with the related party transaction. I mentioned the 5 years on a converted asset with disposition. Well, if we look at what's a minimum, and in this situation, this Resync case, people bought a property with the quote unquote intent to hold it as an investment. They documented the listings for rent. They documented showings. They moved into it after 4 months. They got audited. They got taken to court. They prevailed in court with a 4-month hold. Now, I'm not going to tell you that's a good ruling. I was talking to somebody yesterday that was giving up let's say it was a $600,000 investment property, and they were buying $1.5 million investment house. Well, okay, somebody's buying $1.5 million investment house, unless it's on Lake Tahoe or on the ocean, or in Miami, you're probably not doing that, right? So typically I'm going to look at, I'm going to sort of go under the assumption they're going to be converting it at some point. And once again, we're looking at timelines of conversion, what's comfortable. And what I tell people is, once again, you work with your tax people, make sure they're on the same page. You plan for audit, you hope never comes, right? So that's the deal. You want your tax people involved with these decisions on holding periods and conversion, and understand why these things are happening. And as I said earlier, a lot of times people say, well, 1031 says 2 years, or it says a year, whatever, and it doesn't say any of these things. So there are many times where you buy a property with the quote unquote intent to hold, and then let's say somebody, a neighbor comes up and says, well, gee, the unsolicited offer too good to pass up. Could you take that offer? I'm going to tell you yes, but you don't want to get too lucky too often, right? I mean, because now you're establishing patterns. Flipping property, I don't care what you call it, you're going to say, well, gee, I'm an investor, I flip properties. No, you're a dealer is what you are. And that's a business, it's not an investment. So one, you don't get long-term capital gains tax treatment, no matter how long it took you to fix it. And two, it doesn't qualify for 1031. So we look at this Clarkowski court case, 9 points used to determine dealer status. I use that when I'm looking at whether a 1031 property qualifies or doesn't qualify. I use that same court case and the 9 points used when I'm looking at UBIT or UBTI, unrelated business taxable income, with respect to IRAs and 401k plans, because you might have a Roth IRA and you're thinking, well, gee, I'm going to flip property with this Roth IRA. I won't have any tax exposure. Totally untrue. If you're conducting business with a Roth IRA, you're going to have tax on that unrelated business taxable income. So it's really important to understand these things and how the nature of an investment can change. Pre-COVID, we had people buying properties that you know, they had given up a property held for investment. They bought a property with the intent to hold for investment. Shortly after they bought it, COVID hits. The governor says, gee, the tenant doesn't have to pay. They can't afford to keep the property. So they end up selling it right away. And that might have only been a couple months. Can they do that? And I'm going to say, yes, they can. Their intent was to hold for investment. The nature of that investment changed dramatically and put them in a situation where they, you know, literally it was a hardship situation, which leads me to 121. Do you have an elective time hold and a proration of 121's 250 or 500? I'm going to say you do not, unless it's a hardship for sale. So 121, you can't say, gee, I was in it for 18 months instead of 24, so I'm going to get, you know, 3/4 of that deferral. That doesn't work that way. It's an all or nothing unless there's a hardship. So you're going to, if there's a hardship, maybe it's economic, maybe it's health, whatever that might be, you're going to discuss those things with your tax people. And if you're allowed a proration of the 250 or 500, great, but don't assume you just get an elective proration, because you do not. All right, so it's really important when you're looking at the sale of a home, you look at those time periods. If you're the broker involved, you say, gee, you know, you bought this thing, let's say 20 months ago. Well, you know, if they got gains on it, you're selling their home and they bought it 20 months ago, they better not let it close for another 4 months, or they're going to have a tax consequence on that. There's really no way to mitigate, you know, the tax unless it's a hardship for under that 24-month hold. So really look at this stuff, understand why if you're a broker, why do you get a listing versus somebody else? It's that little nugget of knowledge. If you're the investor or homeowner, really understand these rules. Ask the questions sooner rather than later. Get good tax people involved, right? So in the bold at the bottom of this page, it says typically intent is much more important than the actual time held. And if you look at Clarkowski, it talks about, you know, what's the person do for a living, how often have they done these things, how long they held it is one of the points. What they do with it during the time they hold it. What was their intent? How do you document intent? I had somebody once put in a purchase sale agreement, is my intent to hold for investment. Well, what does that mean? I mean, and is that something that might be looked at as a guilty deal going forward, or are you just sort of trying to establish it and it's a good thing to do? And now I'm not going to answer that. Talk to your tax people. Cornerstones, I like simple. Got to be an exchange. What's given received have got to be a like kind. In order to be totally tax deferred, you need to go across or up in value and equity. And then finally, we've got to have continuity of vesting. All right. So each of these, we've got a page that's talking about. And Ashton, I apologize, I cannot get to that question. So we're going to be addressing questions. I'll get back to you. If you got questions, you can put them up there and we'll address them afterwards via email. I'm sorry I can't get to it for some reason. So anyway, back to the Cornerstones. So one, it's got to be an exchange. You're selling something, buying something. An accommodator is paid a fee to take your sale and purchase and turn it into an exchange. And really all we need to know is your contact information, name, address, phone number, email address, and then we're also going to want to know who's handling the closing, you know, any escrow number, escrow officer's name, phone number, email address, escrow number. If you don't have an escrow number, the buyer's name and the property address. If we're doing deals in New York, it's going to be that closing lawyer's contact information. But you know, different regions, different ways to do it. But really what's happening is when you tell us go, we want that information. We're going to draw an exchange agreement, which covers all the dynamics of the exchange. There's an assignment agreement, which allows us to step in, assuming all rights and obligations of the taxpayer as a seller of the relinquished and ultimately buyer of the replacement property. we are then going to draw up escrow instructions telling escrow what to do for the exchange. Now, with respect to escrow, when you look at the settlement statement, as I said earlier, it's as simple as selling and buying. We turn it into an exchange for you. You look at a settlement statement, it's going to show that we're signing things as the seller of the property or buyer of the replacement property. You, the taxpayer, are going to sign read and approved as the exchanger. Now, as of 1991, direct deeding's allowed. Now, what does that mean? It means that ownership flows through us, but the deed does not have to. So you're going to have a direct deed between you, the seller slash exchanger, the relinquished property, to the buyer, and then on the acquisition side, the deed's going to go straight from the seller to our exchanger, unless we're doing a warehouse transaction. So something where maybe we're receiving a property as partial consideration, our client doesn't want it, so we're going to take ownership, because if we gave it to our client, they sold it, they held it for resale. Where if it comes to us, we sell it, the funds from that sale just get added to the balance of the funds that have come in. So, you know, I want to point out, if you look at a settlement, or not a settlement statement, a purchase sale agreement, does it say total cash paid or does it say total consideration? Consideration could be anything, including property. So when we're looking at these things, a warehouse transaction might mean we're taking a property as partial consideration. It might be a reverse exchange, because the taxpayer cannot legally have ownership of the new and old simultaneously. It might be an improvement exchange where we're building something out, because we can't, you know, give a client a property and then do improvements to it later. We've got to do the improvements prior to transferring that asset to the taxpayer. So one, it's an exchange. And like I said, we're going to draw the exchange agreement, the assignment agreement, escrow instructions. When that property closes, we're going to send out an ID pack. The ID pack gives you the 45th and 180th days, gives you a form to fill out, gives you the identification rules, and really it says how much money we've got, and that's going to need to be figured out. You've got to ID the replacement by midnight the 45th day. So, one, it's an exchange. Two, what's going to receive are like kind. Like kind, as I said earlier, is nature of the investment rather than the form. Any real property held for investments, like kind with any real property acquired with the intent to hold for investment. I want to point out the top left there, 10 o'clock. It says a leasehold interest of 30 years. Okay, so a lease of 30 years duration, or a lease with extensions of 30 years constitutes like kind real property. You know, maybe you're buying in Hawaii, you've got that land lease underneath there needs to be 30 years or more. You know, you're buying something in the desert, a lot of that's Indian owned stuff. So you got to look at leasehold interest, what's going on. It may be possible for us to do actually improvements on property already owned using this leasehold structure. So it's just important to understand that you're not always talking about a deeded interest in property. Yeah, and like I said earlier, I mentioned the comment about selling a land sale contract and who's got title. Well, you also might be in a situation where you're, you know, really, maybe you were transferred the property and it was never recorded. Maybe you got married. Maybe, you know, you got married and you're in a community property. Say difference between community versus non-community. So you know, who really owns it? And you, as the broker, this is a conversation you're going to have when you have that first listing appointment. And you get a hold of that escrow company and title company. They give you the trio, and gee, I thought so and so owned it. Well, you know, who does own it, and does that deed really absolutely indicate ownership? And I'm going to tell you, no, it doesn't. The napkin test. Now, I've talked about this, a few times already, and the napkin test, one of those fallacies was that you have to replace debt, and it's totally untrue. What you need to do to complete a transaction, be totally tax deferred, is you need to go across or up in value and equity between the relinquished and the replacement property. If you're giving up multiple properties or acquiring multiple properties, we're looking at the aggregate value of those things. So in order to be totally deferred, you need to go across or up in value and equity. Those numbers are net of closing costs. Debt is not a closing cost, okay? So just be aware of that, and don't expect debt to reduce what you have to do. And the other thing I'll say is a lot of times people think, well, gee, when I bought this property initially, I put 100 grand into it, and I should be able to get my 100 grand out first. No, no, you're able to get the 100 out after you've been taxed on everything else. So it's not first in, first out. It's basically first in, last out. So understand that any money you pull out of the exchange is going to be taxable, and understand there's something called 1031 G6 that dictates when you can receive funds out of the exchange. And I'm going to tell you, if you're sure you want to pull 10,000 out or 100,000 out of the closing, do it, or out of the exchange, do it at close, because if it gets to us, I can't give you the money until you've purchased everything you have the right to buy. So, understand if you pull funds out, what the tax obligation is going to be for that, and understand when you can get access to that money. But in the bold down there, halfway down, it says debt can go away in two ways. And this is really important in today's world, because what's happening to loan to value, and what happens to your equity in recessionary times? Inevitably, you're asked to, maybe come out of pocket money on the acquisition. And if you listen to so many in the real estate or tax and legal worlds, just basically misinforming people, saying you have to replace the debt, I'm going to tell you, look, value and equity need to be taken care of. You've got to carry both those things forward, and once again, they're net of closing costs. As far as the debt, debt's really irrelevant. Debt can go away two ways. Debt can go away by going down in value, which triggers tax because you went down in value. The other way debt goes away is by adding cash, which is always fine. So it's totally unnecessary for you. As I said earlier, if you're going to go out and buy something, maybe you're selling a property with 100K in debt on it, and maybe it's a $500,000 property with 100,000 in debt, and you want to go out and you want to be totally deferred. You're going to go out and buy the $500,000 replacement property, 500 net closing costs. Maybe it's 470 or something like that, and you don't want any debt, or you can't have debt. Well, that's fine. Just buy the thing outright. So, and I went from the 5 to 470, assuming 6% closing costs, right? So it whacks 30,000 off it. Maybe that's where you are. But it's really the adjusted sales price. Now, every dollar you spend more than you want costs you a buck, right? If you don't spend it, maybe it's 30 or 40 cents. So don't just go buy stuff because you feel you have to, or because somebody said, well, 1031 requires it's all or nothing, which it's not. So every dollar you spend over your basis represents tax deferred gain. Get what you want to get, understand what the tax consequence might be, but that ultimately is the situation. Don't feel like it's all or nothing. And if your basis, if you sold at 500 and your basis was 250 and the perfect replacement was 400, well, you're deferring the difference up to the 400. You have exposure on the difference between the 4 and the 5 net of closing costs. So just really take advantage of the tax people and use them, and understand what your tax obligation is going to be. And it's not all or nothing. I have literally had people ask me, should I spend more? Should I pay more because I sold at a higher price? And my answer, like I said, is absolutely no. If you don't spend it, you're just paying tax on the gain on that piece of it. If you spend it, it's costing you all of it. So just be aware of that. And boot, just for the sake of the conversation, is anything that's not of like kind received in the exchange. Continuity of vesting. All right, the biggest headache with any exchange is time. The second biggest is vesting, and that's just because the person or entity that gave us something has to be given something back. And for example, I'm sitting here in Oregon. Even spouses in Oregon are, if we've got spouses in an LLC, it's a legal partnership. We can do the exchange for the partnership, but we can't do exchanges for the partners. And so what happens is that you've got 4 units or less. The loan's typically going to be a residential loan. Will that loan allow you to buy, via the limited liability company? And what really drives me crazy is larger assets, they require an LLC. Smaller assets, they don't want you to have the LLC. And whether it's an LLC or not, it doesn't isolate you from the obligation of paying the debt. It just provides you, protection from the tenants or liability of the property. So it's really just sort of misunderstood, I feel like, in the lending world, what that LLC truly means. But it just makes things a lot more complicated. If the group of us owns an asset, are we going to own a tenancy in common? If there's too many of us, you can't even use tenancy in common because there's a restriction on numbers. But you know, if it's a big building, we're probably going to own the thing as an LLC that has all of us as members. And what do you think the odds of us going forward together in 5 or 7 years is going to be? We're probably going to want different things. So we have to do a drop and swap, or swap and drop, which is industry slang for dropping from that partnership into a tenancy in common, either pre or post exchange, which satisfies the exchange. And it always comes down to, once again, that holding period and understanding that a conversion from a LLC partnership into tenancy in common does technically reset your holding period. So you've got to understand, you know, what you're up against. And this is, you know, once again, the second biggest problem, second only to you know, the time issues with 1031. The vesting problem comes up over and over and over again. So it's really important, if you're a broker, that you look at that title when you're going after that listing appointment, and start thinking from that context. So, you know, typically people ask when I need to be involved, and like I said, I'd like to know when they're buying it, how they're going to own it, what's going on, because we can have that conversation. At least when they're contemplating a sale, I'd like to have them think about an exchange, but all too often I don't get involved until a deal's pending, and now we've got to clean this stuff up. So that's that vesting piece really gets to be problematic, and may even be more problematic depending on whether you're in a community or non-community property state. Partnerships. This is back to industry slang on the drop and swap, or the swap and drop. A drop and swap means we're going to break the entity to tenancy in common predisposition, and really, you know, even if we met a year predisposition before listing the thing, even we might be sitting in a room, you know, a dozen of us owners and our tax and legal people, and we leave that meeting, everybody is in agreement we're going to drop to that tenancy in common. And then I get a call a year later, the deal's now pending, and I get a title report that shows it's still owned as a, you know, LLC. Well, at that point, really, you know, a drop from the reason I said a year in advance is back to my comment on holding period. So maybe we break it a year in advance, and now you can definitely defend your ability, or not your ability, but the fact that you own that property for investment predisposition. Where if we wait till it closes, and now that drop happens, now what's going to happen is we're going to have escrow draw a deed from the entity, the individual's tenancy in common, and now you've got the purchase sale agreement that's being amended, you know, or, you know, assigned from the entity to the individuals going forward. Certain states, for example, California, they don't want to see that. They don't want to have it in their face. So basically, they're going to tell you, you know, rip up the initial PSA and have a new one that's from inception between the tenancy in common and the buyers, not from that entity. Now, let's say that nobody's comfortable doing the drop predisposition. So now we're looking at a swap and drop. And so what that means is we're going to do the exchange for the entity into a number of properties that, you know, each property is desired by each member of that partnership. And then maybe a year after acquisition, maybe we buy 5 properties. And what I'd say is, let's buy 5 properties in 5 different entities with the exchanging entity as the member of each of those. And a year after acquisition, you do an assignment of membership interest from the entity to the person that wants each of those respective properties. So you don't have to have title, you know, policy changes, or, you know, if there's, you know, lending or whatever, you don't have to have deeds drawn to do those assignments that would actually transfer the asset to the respective owner. So you understand that maybe there's 3 or 4 of us that are in an LLC, and 2 of us want to pay the tax. Well, we're going to take the 2 that want to pay their tax out predisposition and keep the people that want to do the exchange in the entity going forward. So, you know, this is obviously a conversation. This is a whole nother class, by the way. But this is a conversation that is really important to have. So when if you're a broker and you're taking that listing appointment, once again, really understand how things are owned, you know, who wants to do what, and, you know, let's cross this bridge on conversations sooner rather than later, because it really makes things more cumbersome. And we've got lots of people that are just sort of consolidating investments. I've got a number of groups of people that have worked together for decades, and now they're sort of looking at segregating their different properties, and just for estate planning purposes. And you know, we might be able to utilize what we call a true swap to get some of the stuff done, but we really need sort of a spreadsheet showing the assets, how the ownership, and helping people get where they want to go. This is the planning component, and this is where, you know, I'd like to have those conversations with you guys sooner rather than later. When can I get my money? And I'm sorry, we're already. I sort of warned you up front. This is the first time I've done this presentation, so I'm over on it. I'll give you more credit hour if we get further. But anyway, as far as when I can get my money, our hands are tied. So anybody in the exchange world that's a legitimate exchange company, they're not going to give you money outside 1031-G6. 1031-G6 basically says after the exchange company gets funds, they can only let funds out to the taxpayer when they've purchased everything they have the right to buy, which means that if the funds all come to us at close, then we are not able to allow funds out of the account for anything other than a purchase until the 46th day. So inside the 45 days, you can literally buy anything you want. So therefore, we can't release funds. After the 45th day, we can give you your funds or residual funds after you've purchased everything you have the right to buy. So what's important is if you want money out, like I said earlier, you can take it out of close. And if you take it out of close, it's specifically excluded from the exchange. Our assignment agreement that I mentioned earlier has a little blank, and it asks whether you want to retain any taxable proceeds. If so, how much, and you're going to fill in that blank. You're going to walk out of escrow with those funds. They're taxable to you, but they've been excluded from the exchange. Therefore, we don't have to worry about 1031-G6. Now the funds get to us. As I said, I can't let funds out for any reason prior to midnight the 45th day. After the 45th day, I can do it after you've purchased what you have the right to buy. So in our ID packet, when it goes out on the ID form, it's going to have, remember the 3 property rule, 200% rule, 95% rule. Each of those work independently of one another, but you're going to have the rules there. You're going to have a form there, and you're going to fill out on that form. You're going to give an address or the percentage of ownership you're getting of that address, and maybe a value on there. And then if you were thinking that you're identifying, maybe you're IDing 3 properties with the intent to buy 3. Well, that's one thing. Maybe you're IDing 3 properties with the intent to buy 1. Well, whatever you're doing in our ID form, under where you're identifying those properties, there's a paragraph that says, I'm identifying these properties. I reserve the right to buy whatever number of those. Now, you're going to put in there the number that you want to acquire, you intend to acquire, and then cap it at that. Because if you say I'm IDing three properties, I intend to buy 1, I reserve the right to buy 1. You put 1 in there. Now, as soon as we close on the 1 by identification, you have restricted yourself to the 1. Therefore, any residual funds in the account we can give to you. And like I said, this is very important because the opportunity cost of the exchange. And if you identify something just in case and you really don't want it, and that property doesn't work out, now you're stuck with me until day 181. I can't legally give you that money. So it's really important on the 45th day, you're either totally committed to completing the exchange or you should terminate it. And the problem is not whether the exchange company's not being difficult in this situation. The problem is this, and you think, well, gee, if I want to pay my tax, why shouldn't I be able to pay my tax? Well, I understand that, and that's the way I used to look at it. But there were rulings that came out basically by the federal government that said if the exchange company doesn't follow 1031-G6, that's a flawed procedure, and any exchange done using that flawed procedure is null and void. So it's not the fact that you are willing to pay your tax, it's the problem that if you were to do that, and we were to allow that, then all the exchanges that we've done are invalid. So there's nobody in the exchange world that's going to do that if they understand the repercussions of that transaction. Few examples, things people are doing, and this sort of dovetails into what I just said about timelines and buying the opportunity. So, this time of the year, number one, understand that we've got a situation where the fine print 1031 says 180 days for the due date of the tax return. So at this time of the year, you need to complete the acquisition, complete your exchange before filing a return. Now that obviously gets more and more difficult as we get up against April, or up against the year's end, and then we've got a situation where that April 15th date in the following year is going to come maybe 3 months into it, right? So or 4 months into it. So you need to understand that if you're not going to complete the transaction pre-April 15th, you're going to file an extension to get you outside that. So you want to complete the transaction before filing the return. As we just discussed with 1031-G6, you can only receive funds after you've received all property you have a right to buy. We are doing a number of partial exchanges, so it's up to you to decide at what point the exchange makes sense or ceases to make sense. Give it a shot. A lot of people are just sort of buying the 45 days, trying to figure out whether they can complete the transaction. If they don't find something within the 45, they just terminate the deal. Failed exchanges could not complete. That would be an example of one. What's a sort of a fallback in that case is maybe instead of doing that, you go into a QOZ or OZ, and I sort of look at those as like a Roth IRA. You got limited deferral into the asset. What you make on it, if held through maturity, is going to be totally tax-free gain. Moving on up or down, we've got people consolidating investments. We've got people leveraging into other stuff. It's just really the people that are doing deals today are doing deals. The ones that can't are unfortunately sitting there watching what's going on. DSTs and TICs, mailbox money, non-recourse debt, stuff like that. So people, rent control refugees. Lots of people going into these institutional offerings are just sort of done with terrible T's. And then we've got a number of people that are actually leveraging. They want to defer their IRAs, 401k plans into real estate, and they can do that either alone, or they can do it actually combining personal money and plan money into a common investment. Related party transactions. We've got a few more pages. We're done. Related party deals. Okay, so I mentioned related parties earlier when we're talking about hold periods. And typically you can, and with the hard market, what's going on, understand you can sell to a related party in exchange. Typically you can't buy a replacement property from a related party. The exception is if both parties are doing exchanges and both parties actually hold their replacement properties for no less than 2 years, with the exception of somebody that's able to document there's absolutely no intent or effort to avoid tax. Is 1031 avoidance? I would say no. I'd say 1031 is deferral, right? So don't look at it that way. But once again, it's related party transactions. Selling to related parties, okay. Buying from one typically is not, unless both parties are doing exchanges. Both parties hold their respective replacement for no less than 2 years. You got to go. I understand. This stuff is all going to be available to you. This is a page on seller finance, notes, and exchange. 5 different ways to do a transaction carrying paper. What happens is at close, the notes got to come to us. And by the way, there's certain organizations in this country right now, and some of them are, all about flipping properties, and they've got all these views on YouTube and everything else. And I've really about had it with them because they really put out a lot of information that's just dead wrong and just bad information. So, I've had a number of clients recently where they're telling, some of these quote unquote wholesalers are telling them that the tax consequence on seller finance or their ability to do an exchange is going to be there when the note is being paid off. That's totally incorrect. The tax consequence on carrying a note occurs when you sell that property. And I also want to stress that you're going to have tax exposure on debt relief and depreciation recapture in the year of disposition, even if you don't receive a single principal payment. So if you're carrying paper, talk to your tax people, number one, understand what the tax consequence is going to be. These nothing down deals are, in my opinion, horrible for a seller. And the reason is, one, you better get enough at closing to pay the broker's commissions, any tax or legal fees, the escrow, the escrow fees, and if you're doing an exchange, I'd like to get paid too. But you're going to have closing costs associated with this, and then if you've got something that was depreciated, you're going to have tax on depreciation recapture, and if you got debt on the property, you're going to have tax on debt relief. So it's really critical that the taxpayer understands on a seller carry what their tax obligation is going to be if they're carrying something. And I think you as a broker for that property owner, you really need to sort of make sure they're aware of potential problems there, because these quote unquote wholesalers are not being truthful. And I've got a number of definitely elder clients that are being told things that are dead wrong and being put in a bad spot. So there's no urgency to getting deals done unless somebody's trying to do something crazy. So really look at these things and understand the repercussions of actions. But if you do a seller carry, there's 5 ways to do the transaction. One, first off, for any of these to work, the note has to come to us. We could sell the note to a third party. those things, the discounts often are in excess of the tax consequence, so it doesn't happen a lot. You can use the note to acquire replacement property. Rarely happens because the seller of the replacement property doesn't know anything about the buyer, doesn't know anything about the property. They just don't want the paper. The third option is one that typically happens. Our client, the taxpayer, the exchanger, buys the note from us. You go, gee, why would I buy my own note? What you're really doing is substituting cash for the note, which then gives you the ability to have the benefit of the installment sale without having capital gains tax on it. You're still paying normal income tax on the interest that you're receiving, but it gives you the ability, you're substituting cash for the value of the note, which allows you to complete the exchange, totally tax deferred. The next one might be a situation where maybe the property doesn't qualify, or maybe the financing blew up. So maybe it's 30-day, 60-day, 90-day note. And then as soon as that note matures and we get paid off, now we've got all the cash to complete the transaction. So that's a great solution in a situation where maybe a lender required repairs weren't able to get done, or maybe you had a transaction blow up, you still want to get it done. And then finally, we've got the ability to do a partial exchange. So maybe you defer the down payment, you pay tax on the installment sale deal, and that, whether that makes any sense, is really truly up to the down payment, what the total gain is. Reverse exchanges, I'm really not going to cover this. I just wanted this slide in here so you understand that just as in a delayed exchange, you've got 45 days from the settlement of the disposition to ID what you want to buy, 180 days to get it done. On a reverse, it's 45 days from the date of acquisition to ID what's selling, and 180 days to actually sell it. You can't legally have ownership of both properties at the same time, so a warehouse relinquished. Reverse exchange means that we are going to buy the replacement property, immediately give it to the taxpayer, and simultaneously they're giving us the property to be sold. A warehouse replacement means that we're going to buy the replacement, have title to it until the relinquished property sells, at which time it goes away. We transfer the new property to the taxpayer, and then we repay the debt. Now, a warehouse replacement reverse is the same structure as a improvement exchange. So it's a situation where we're going to take ownership. The only difference between warehouse replacement reverse and improvement is we're actually building on the property during the time we're on title to it. Personal ownership of an investment property, as far as joint ownership in things with a IRA or 401k, tenancy in common I like because, one, if you're doing an exchange, you can exchange into a tenancy in common ownership. You cannot exchange into a partnership interest, which is an LLC. But the reason I like the TIC is it allows you to exchange in, but it also allows you to exchange out. And if we take ownership, joint ownership via LLC, now we've got a situation where we have, upon disposition, the IRA 401k funds might be totally tax deferred, but you personally are going to have tax exposure. So we might have a situation where we've got to do an exchange for the entity. But there's two ways to do these things. If you want to combine personal money and plan money into a common investment, it's either tenancy in common, which I personally prefer, or via common membership in a limited liability company. If we were to, let's say, do joint ownership via LLC, it's quite often the case where at the end of the day, somebody wants to take money out of a distribution. They want to take a distribution of the IRA 401k owned component. They want to ultimately own the entire asset personally, and that's very easy to accomplish by simply doing assignment of membership interest in the LLC as a distribution, and that ultimately transfers the asset to you directly from your retirement account without having to have deeds done each time. And if you take minority interest distributions, you've got a valuation opportunity. You might have discounting that can apply too, so it's pretty attractive. A couple examples when we're wrapped up here, and I've seen a few of you head out, and sorry we're running long. This is an example of it's not all or nothing. I really think it's important today to understand that we're in a different shifting market, and you might not be comfortable having the debt on a replacement of what you had on the relinquished, or maybe you just don't want to spend all the money. So this is an example of a transaction where the property, the relinquished property, was $3 million, replacement property was $1 million. So they had $2 million in boot. they still had a tax basis of 250 on the relinquished property. So they still deferred gain on the difference between the 250 and the million. Remember, I said every dollar spent over your basis represents tax deferred gain. So you still had the difference between the 250 and the million, deferred tax on 750, which saved them $250,000 in tax. So, get people what they want, and it's not all or nothing. And this is a great example of that. They still saved $250,000 in tax, even though it went from 3 to 1 in this situation. An example, just leveraging into things and flipping properties. You've heard me talk about a few times today. That's not investment. It's dealer status. You're paying normal income. You don't have the ability to do an exchange, no matter how long it took to flip that property. So instead of flipping properties, it's much better to have a situation where you're going to exchange into a property or buy a property. And let's say, if you look at bigger pockets, for example, everybody's running around talking about this BRRRR concept like it's something new. Well, the idea has been there for decades. So when I got into investing in the late 80s, we were buying properties, doing the improvements, doing a cash out refi, renting the thing out, and we'd hold it for a year or two. Well, why would we hold it for a year or two? Well, we'd hold it for a year or two to season it as an investment. The refi money wasn't taxable, and then after seasoning it as an investment property, you do an exchange. So instead of paying normal income tax on it as a flip, you never pay any tax. And the BRRRR deals, it accomplishes the same thing. It just misses that last piece. And with the ability to liquidate the investment, move all your equity into something else. And of course, there's arguments of, well, why would you sell a great piece of property? And honestly, I've got I've definitely got properties in my rear view mirror that I wish I'd never got rid of. But as far as your decision, your tax exposure is driven by your decisions. And this slide just exhibits a situation where you're buying, fixing, and seasoning assets before you're relinquishing, so you're not paying tax on it, not paying normal income tax, you're not paying long-term capital gain tax. You're able to do the exchange because now it's held for investment instead of resale. This is an example where this is phantom gain. So this was happening until about 5 years ago, and I fear it's going to be coming back. So in these situations, we ended up handling lots of deals throughout after that 2007 to 2009-10 period. For the next decade, roughly, we were doing, phantom gain 1031s. And in this situation, what happens is a lot of these were institutional offerings, so that an LLCs would be tenancy in common on an asset, and we do an assignment of membership interest. As soon as we hear the property is going to go into foreclosure, we might have 20 exchanges we're putting together immediately predisposition. So there's assignment of membership interest in each of these entities to us. And that assignment, that starts the clock. It's not the date it's foreclosed. And what we're doing in this situation, we're isolating the taxpayer from actual constructive receipt of the debt, the debt relief typically. And for people to figure out whether this makes sense is pretty easy. You're saying, okay, gee, a lot of these were non-recourse debt, so it didn't damage the taxpayers' their credit. And their situation was they might lose 35–40% or pay 35 to 40% just for the pleasure of losing the asset. And they're coming out of pocket that money. And if you go out and buy something, your loan to value might put you at 30 cents on the dollar. So you might be in a situation where you're actually spending less and getting something than just having to pay more and get nothing out of it. So it's really important that you understand that, once again, when we talk about base and gain, it has nothing to do with profit. It has nothing to do with you receiving funds. It's merely a tax calculation. You got to understand what it's going to cost you in a recessionary time if there is a short sale or foreclosure. This is an example of converting a primary residence into an investment. These people got referred to us by a law firm. They were looking at $1 million tax hit, $3 million gain, 250,000, or they were married, so they get $500,000 was going to take care of it. But we saved them, actually over $1 million in tax in this situation. We told them to move out of the house, season as an investment. They did. They had done a refi, went out and bought a new home to live in. They held this property for, I can't remember what the exact timelines were, but it was in excess of a year when they sold it. She was CPA, he was an attorney. They went out, bought 24 different replacement properties, closed them all inside the 45 days because she did everything. She didn't want to wrestle with the properties acquired were in excess of 200%. So they would have had to close 95% of the aggregate value of all properties ID'd. By closing them all inside the 45 days, you didn't even have to identify them. So it went from a $1 million tax hit to zero, and they got 24 different properties. Very happy situation for them. This has nothing to do with 1031. It's teaser to have you come listen to our IRA stuff. And I did see some names today that were on yesterday with the IRA stuff. Same example I gave yesterday. This is just an example of what's possible with retirement accounts. So, once again, recessionary times, those with gold make the rules. You might have a chunk of money sitting in Wall Street. You like to diversify out. IRAs, 401k plans, they're not all or nothing going into self-directed stuff. But this is an example of a situation where we had a retired couple come to us wanting to buy a mobile home RV park, and we thought we'd do what's called a checkbook IRA. They then told us they wanted to live there and be, compensated, be the on-site managers, which that all would be problematic with IRAs. So we shifted gears into a rollover business startup, which allowed them to make an investment, get a job and a place to live, all with the one transaction. And if you've got more questions on that, please reach out. As I said earlier, we've got a very robust YouTube channel. I do see somebody asking, do you have a video? But I can't see what the rest of the question is. Sorry, Bob, but we will get you an answer on that. Lisa, I see you've got a question too, and a few others. So we will get you answers to your questions. But please like and subscribe that channel. And if you've got something you'd like to see us cover that we don't have up there, please let us know that. If you would like a presentation on it, let us know that as well. But it really helps us out, and we really enjoy putting the content out there to give people an idea of what opportunities are out there for them. And I really appreciate the time today. Once again, David Moore, Equity Advantage, and look forward to hearing from you soon. And take care. Best health, everyone, and look forward to talking with you soon. Thank you. Bye-bye.